So the earned income credit, as it says here, designed to help working taxpayers who are economically disadvantaged alleviate the burden of certain additional taxes such as gasoline and Social Security taxes. EIC is a refundable tax credit. Okay, this is the big one. This can be worth a lot of money, several $1,000s to individuals. And this credit's kind of funny because so usually we had like our credits, the value of our credit, so an AGI, usually we'll see like something like this. As the AGI goes up, the value of our credit goes down, right? The EIC though, kind of does this. There's a sweet spot up here where there's a maximum credit. And so this is one of those credits where people will actually, if they're inclined to commit fraud, will actually manufacture income in order to get up into this sweet spot. So if their income is down here, maybe they'll say they have a Schedule C business where they got income in order to get up here to this sweet spot. So it's one of those kind of rare areas where people will add fictitious income rather than creating fictitious expenses. So it's kind of, because it's got that little curve there, it can be kind of a difficult calculation to do. Now luckily there's a table that we can use as well, but there is also a calculation for it. So anyway, it's a refundable credit. Taxpayer has to meet certain requirements and they have to file a tax return. Also, any taxpayer who is being paid to file taxes, so paid tax preparers, who claims an earned income credit for a client, on behalf of the client, is liable if the credit is claimed fraudulently. So there are additional substantiation requirements on preparers. Like I said, this credit has a lot of fraud attached to it because it's so valuable, right? So there are additional steps that paid preparers, like if you're taking the VITA class, the volunteer, it doesn't apply to you because you're a volunteer. If you're getting paid and your client is taking the earned income credit, there's just additional documentation that you have to get from the client in order to verify that they are eligible for it. The earned income credit, you might not have a child, so you may or may not have a qualifying child in order to qualify for this. Now, the income limits for those without a qualifying child are very low. There are also very strict age limits for individuals to claim this credit, which essentially, once you're 65, you can't claim the credit anymore. Retirees oftentimes, as we know with the Social Security benefits, if they're only receiving Social Security or they have really not a whole lot of other income, they don't have a lot of taxable income. So cutting it off at that age 65 eliminates those retirees, well, they don't have earned income anyway, but eliminates the possibility that just because they have non-taxable income that they're not claiming this credit. I didn't explain that very well, but there's an age cutoff. It has to do with retirees. So taxpayers can claim it with or without a qualifying child, but the amount of the credit varies depending upon earned income and how many children that are claimed. So 1, 2, 3 or more. So maximum is really 3, because if you have more than that, you're still in that 3 or more category. Oh, there's the adoption expenses form here. All right. Earned is called earned income credit. That means it's earned income. Has to be some wages, self-employment income, anything that is subject to Social Security and Medicare tax would be considered to be earned income. Okay, tips would be included in that. Earnings from self-employment minus the 1/2 of self-employment taxes. So we'd have to reduce the self-employment income by that 1/2 of the self-employment taxes. Taxpayer who has a net loss from self-employment must reduce their earned income by the amount of the loss. So if you have wages of $20,000, but you have a loss from self-employment of $5,000, your earned income is now $15,000, okay? That may take you out of that sweet spot. You might be inclined to not claim some expenses that you otherwise would claim, right? So, what is a qualifying child? Remember, you don't have to have a qualifying child to qualify for this, but if you do have a qualifying child, it's much more valuable. So what is a qualifying child? They have to either have a qualifying child or meet certain other qualifications. So it's got to be the taxpayer's son or daughter, grandchild, or descendant of the grandchild. So great-grandchild, that's the printer going off. Stepson or stepdaughter, or a descendant of either of those. Eligible foster child, so taxpayer someone cares for as their own child and who is brother, sister, stepbrother, stepsister, descendant of a person in one, or a child placed with the taxpayer by an authorized placement agency. So if you're a foster family, the state has placed a child with you, that would count. Or an adopted child. Also, the child must live with the taxpayer for more than half of the year. They must be under the age of 19 or be a full-time student. So this is like the qualifications for a dependent, right? So if they're under 24 or between 19 and 24, then they have to be a full-time student. The child has to be younger than the person that's claiming the child, again. They cannot have filed a joint return other than to claim a refund, so just like the qualifying child requirement, and they have to have a social security number. That's actually a fairly recent requirement over the last few years. It used to be that they did not have to have a social security number. Now to have a social security number, you have to, I don't know all the specific requirements, but that social security number is different from like a taxpayer ID number. So there are individuals who don't live in the US, maybe they're dependents of people who do live in the US, but they have taxpayer ID number. Taxpayer ID number is not enough, you've got to have a social security number. So the person has to, the qualifying child has to meet the requirements of having a social security number. If there is no qualifying child, in order to be eligible for the credit, all of the following criteria must be met. So this is for the individual, the taxpayer, if there's no qualifying child. Their principal place of abode has to be in the US for more than half of the year. They have to be older than 24, but younger than 65. So this kind of eliminates college students and retirees. So we're looking at those individuals, the vast majority of individuals who are working age, right? Case of married individuals, at least one spouse has to satisfy the requirement. So if you're married to somebody who satisfies that requirement, that's fine too. You cannot be claimed as a dependent of another taxpayer. You cannot be a non-resident alien for any part of the year. So if you went from being a non-resident alien to a resident alien on December 31st, you can't claim it that year. You'll have to wait till the next year. All right, so calculations. So multiply earned income up to a certain amount, so that maximum amount of income, earned income, multiply it by a percentage. When the earned income exceeds certain levels, the credit begins to phase out. Percentages for the credit and phase out amounts vary depending on filing status and the number of qualifying children. You're going to see in this table that we have here what those limits are. Let's see. Filing status, appropriate percentages earned income credits are shown in the table below. As they say here, this can appear intimidating, and it kind of is. Its application is fairly straightforward. So, married taxpayers with 2 eligible children would use the 2 column. For earned income up to $15,410, taxpayer would be entitled to a credit of 40% of earned income for tax year 2002. So let's look at the if they have 2 qualifying children. So here's the table. again, if you follow along, it will lead you to where you want to go. So if you have no eligible children, if you have one, if you have two, if you have three or more. So there are phase out ranges for joint filers and from here to here. All other filers, so that would include head of household, married filing jointly, all of that stuff. These are our phase out ranges depending upon how many children or if we have no children. All right, so let's see if they've got so this table is handy to bookmark, okay, when you're doing these calculations. Or you can also use the table that I'll show you in just a minute. Okay, so married joint filers with earned income between $15,410 and the phase out point of $26,260 are entitled to the maximum credit. So you can see we have it's not zero. That's where the table comes in. You know, it goes up to that amount. And then, so if your income is between $15,410 and $26,260, you get the maximum credit. That's the sweet spot. However, once earned income rises above that, the EIC is reduced by 21.06%, this amount, of the excess, so amounts over 26, until the earned income reaches $55,529. Once earned income reaches $55,529, the EIC is eliminated for those married filing jointly with two or more. This is the max. So if you've got three and you're married filing jointly, your income limit is $59,187. After that point, the EIC phases out. Okay, so this is the phase out. This is based on the number of dependents. This, once income exceeds these amounts based on these filing statuses, it becomes zero. There's no earned income credit. Okay, so if you are single and you have no children and you earn more than $16,480, you get no earned income credit. But if you are single and have three or more children, your income can be up to $53,057. Yeah.
So if you're less than the phase out amount, like where it starts, do you get just like whatever the percentage is off of what you earned, like the 7.65%?
You'll see.
Okay.
We'll do a calculation here. That's where you get a lesser amount. Like you don't, because it's, like I said, because it's based on, a big chunk of it is based on how much you paid in Social Security taxes. So if your income was below this amount, you didn't pay as much in Social Security taxes as somebody who earned more. And so this is kind of like a refund of those Social Security taxes that were paid. And that's where that 7.65% up here comes from. This one, of course, they increase it because of the additional dependents. So let's see. We got an example here. All right, so Danny and Wanda. We have two eligible children. They file a joint return. They have earned income of $38,025. All right, so $38,000 married filing jointly. $38,025, two kids. Okay, so they're going to be in that range. $38,025, married filing jointly, two kids. So between here and here. Okay, so here's our phase out. So the first thing we have to do, we're going to take the maximum credit. All right, so we're going to get the maximum credit, which is on that table for that. Take that 6164. Then we've got to subtract. We've got to take, whoops, sorry. Their AGI 38,025 minus the lower end of that phase-out range. Okay, so how much they are into that phase-out range, we're gonna multiply that by 21.06. Again, we get that percentage from the table. Because they have 2 children. If they had 1 child, we'd multiply it by 15.98%. Okay? So we're gonna take so AGI minus the bottom, or phase out, well, bottom of phase out, times the applicable percentage. And this is based on number of qualifying children. So in their case, 38,025 minus what was the bottom, 26,260, which is whatever that is. And then we multiply it by 21.06%. We're gonna subtract that amount, 2478. So we get 3686. So this was married filing jointly, 38,025, 2 kids. Let's change it up a little bit. Okay? Using that as a guide. We'll change it up a little bit. Let's say we have single. We'll use the 38,025 for single, and we'll say 3 kids. All right. So, phase out starts at, so this is single, starts at 2130. So let's get this out of here. Gotta find our maximum credit first off. So 3 kids, maximum credit is 6935. Now we're gonna take our AGI 38,025 minus the bottom of our phase out range for those 3 kids, 3 or more, 2130. And we're gonna multiply that by 21.06. We're gonna subtract it. How much is it?
I'm sorry, I was telling her the.
Oh,
of what
gotcha.
she's,
3,769.
We're gonna subtract that, so whatever that is. You can do that for me too if you want.
3,166.
Mm-hmm.
So I've got a question. So one of the questions on like the smart book is over the what is this one called, the earned income credit?
Mm-hmm.
But I'm not sure where it's getting the numbers from because they're different than like what's used in the table here.
Okay.
Can I?
Do you have it up?
Yeah.
Cause I'll have to look at yours because the
Yeah.
smart books are all individualized, so.
Because then it gives like the reason, but when I go like this number isn't any of those ones for the like maximum.
So, source of income. So is she single?
Yeah.
Or wait, wait a minute.
Single with 3 dependent children.
So single, 3.
But it's saying that like the max to like start with is 6,729, but I don't have that, have the 6,900
else encounter that as well? In the smart book? So,
But it should be just
Yeah.
what that is, so just don't worry
Yeah.
about this, okay,
yeah,
okay.
it's, yeah, they've got the wrong
Okay.
6720, and I don't have a copy of last year's book with me to see what those phase out ranges were. I can look here, let me see. Yeah. 6728.
Okay, so it's just last year's, so,
They
okay.
didn't change the question, they missed that question and changing it. So choose whichever one's closest. That's a pain. Okay. So, yeah, if you could kind of keep this in mind, AGI minus the bottom of the phase out based on the table, multiply it by the percentage on the table, right? We'll take the maximum minus whatever that result is, that's our earned income credit. I think there's, let me see something real quick on the. You guys know these were all up there? I don't see that I have an EIC one up here though. It's probably a good one to have. Alright. Let's look at this next one here. Saul and Tammy have a 4-year-old daughter, Brenda, who is a dependent. Combined earned income is 26,500, so they are married, filing jointly. One kid. Table. Minus. Married, filing jointly, one kid, 26,260. Am I seeing that right? %. And maximum EIC is 3733. Minus, and what is this? 26,500 minus 260 is 240 times, how
Just move the table.
Well, what's 240 times 15.98%?
No, so I calculate this one already.
Hmm?
It's already. Go back.
No, I know, but I wanna do. I know the answer's there. How much is it? 38. Okay, so 95, 36, 95. Sorry, I'm having fun with the, let's see if I'm right. I didn't want to, 36, 86, how did I get 36, 86? Did I do that wrong?
No, sir, you
No, wait, 2 eligible children, oh, did I look at the wrong?
yeah.
Oh, I did.
No, sir.
Oh,
you-
they've got 2 eligible children, 61, 64. I thought they had 1. Who had 1? Somebody had 1.
It's a level. Yeah,
Oh, this one?
yeah, this one.
Oh, yeah, 36.95. Okay. Just looking at the wrong one. Okay. So taxpayer is ineligible to take the earned income credit if they have disqualified income in excess of $10,300. This would include dividends, interest, both taxable and non-taxable, rental income, royalty income, capital gains, and passive income, okay? So that 10,300 is the magic number there, regardless of whether they're, even if their earned income is less. Because the assumption is that if they've got that, they've got assets. They don't, they've got some sort of assets that they can draw from. So there is an advance child tax or earned income credit that taxpayers can claim in their withholding. So they can get up to 60% of the anticipated credit in the form of reduced withholding from their paychecks. So it means that it's spread out over the year when they receive it. So you have to be careful to make sure that people haven't already taken it, because you gotta figure that into the calculation. Let's see. Okay, so there is a table as well. Do we have a link to the table? Oh, here we go. No, that's 9.3. Okay, I want to show you the table at the end of the chapter. I think it's at the end of the chapter or the end of the book, I can't remember which. End of the chapter. Okay. So looky here, there's a table. So if the amount, so you've got to go to find your credit, read down at least but less than, let's see. Go to your, let's just use this one as an example. 37, so 26,500. And again, we're gonna use the second line. If you remember from payroll accounting, we always use the second line. How many children? We've got 1 child. This would be 0 children. 1 child, 3691. So just like the tables, that doesn't help. Just like the tables that we use in payroll accounting, if it's a table, it's not gonna be as precise, because you got a range of income, you got a $50 range of income here. Where doing the calculation, we get it precisely. But you can see, if you look at the table, you can see what I was talking about with how the credit increases, and then you get to the top sweet spot, and then it starts to decrease. So if you look, even just, let's look at married filing jointly. So lowest income here, we've got 11. Just look at the column on the far right. This is the amount of credit. So up to 2509, and then we keep going up, 29, 34, 39, 53, between that, within that range, it's at the top. And then you can see it keeps going down, 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 until we get to 0. And it phases out completely. Okay, so just kind of an example of how that, what I was talking about with that. Questions? So the earned income credit form is here. I think the one that you have to do is just here. I don't know. Do you even have one in your,
Yeah.
yeah? Is it, well, chances are they've got the form on another page here. Maybe not. Is this the only form that they have you fill out? That's the adoption. Oh, we probably have a little bit of time, we can take a look at it. Okay. Let's finish this up with premium tax credit.